In 1790, the United States had something in common with every fragile country that wins a war before it learns how to pay for it. No money, no credit, no trust. The federal government owed debts it couldn't repay, the states owed even more. And the national currency had collapsed so hard that "not worth a continental" became a punchline with teeth. But here's the important part. This wasn't just a young nation having a rough start. It was a recurring problem with a recurring structure. When a system is born out of war, it usually runs through the same five-step cycle. First comes the debt panic. Then comes the scramble to repair credit. Then comes the building of a stabilizing institution. Then comes the backlash over who controls it. And finally, the stress test. What happens when that stabilizer is removed? That cycle is the real story here, because the fight between Alexander Hamilton and Thomas Jefferson wasn't just a personality clash. It was Step 3 colliding with Step 4 in real time, inside a country that wasn't sure it would survive Step 5. Before we get into the brawl, we need to control a few terms. Otherwise, this gets hijacked by people arguing with a version of the story we're not telling. When I say national bank, I do not mean a modern central bank. This is not the Federal Reserve. It is not setting mortgage rates. It is not managing the entire economy. In this era, a national bank is closer to scaffolding, a place to hold government funds, a way to issue notes people actually accept, a mechanism to make payments predictable, a tool to stabilize a young credit system before it collapses under its own improvisation. Second, when I say assumption, I mean the federal government taking the state's war debts and turning a chaotic pile of local IOUs into one national promise. And third, when Jefferson calls the bank unconstitutional, he's not just quoting legal text for fun. He's making a deeper claim that once you build a powerful financial mechanism, it doesn't stay neutral. It attracts influence, it concentrates control, and eventually it starts shaping the country that built it. One more thing. This is not a story about saints and villains. It's not bankers bad or farmers good. And it's not financial advice. This is a constraint story. A story about what systems tend to do when they're buried in debt and forced to choose between chaos and control. Now, with the language cleaned up, here's the cycle again clearly so you can track it as it happens. Signal 1, debt panic. The bills exist, the money doesn't, and trust disappears. Signal 2, credit repair. The system has to prove it can be paid back, or no one lends again. Signal 3, institution build. A stabilizing machine gets created to impose order. Signal 4, power backlash. People realize the machine has leverage, and they fight over who holds the lever. Signal 5, removal and stress test. If the stabilizer is weakened or removed, the system finds out what was real and what was pretend. That's the map. Now we walk it. After the Revolution, the United States didn't win prosperity. It won invoices. War debt was enormous. The states were financially mismatched and politically suspicious. Some states had paid more, some had paid less, some had functioning tax systems, some basically had vibes. Merchants didn't trust government paper. Foreign lenders didn't trust the Treasury. And the country didn't have a unified financial structure strong enough to borrow on reasonable terms. Which brings us to Signal 1, debt panic. In the 18th century, a nation that cannot borrow is a nation that cannot defend itself. And a nation that cannot defend itself becomes a tempting target for anyone watching from across an ocean. So the United States had to repair credit. That's Signal 2. And this is where the country splits into two philosophies that still show up anytime money and power touch the same wire. Alexander Hamilton looked at the mess and saw a system that needed structure. Thomas Jefferson looked at the same mess and saw a republic at risk of replacing one central authority, a king with another central authority wearing cleaner shoes. And now Signal 3 arrives. The question becomes, what stabilizing machine do you build? And who gets stuck holding the lever? Enter Hamilton, stage left. Hamilton proposed a plan that was radical, elegant, and terrifying to anyone who distrusted concentrated power. First, the federal government would assume all state debts. Second, it would establish the credit of the United States. Third, it would create a stable national currency. And fourth, it would build a financial institution powerful enough to coordinate the entire system. This is Signal 3, institution build. Not because Hamilton loved banks, but because a country with no credit can't function like a country. A Bank of the United States, not a state bank, not a regional bank, a national engine that could manage payments, issue notes, hold government funds, and stabilize the young country's finances. Hamilton believed money needed order, discipline, predictability, structure. He didn't trust 13 states pointing in 13 directions. He trusted a centralized system that could impose stability where chaos already lived. And when you build a stabilizing machine, the next phase always shows up, because someone has to hold the lever. Jefferson looked at Hamilton's proposal and felt a deep, instinctive recoil. A centralized bank, backed by the federal government, run by directors connected to commerce and finance? To Jefferson, that looked like a remake of the British financial machine, the very system he believed they had just fought a war to escape. Jefferson didn't see stability. He saw an aristocracy forming in real time. He argued that a national bank was unconstitutional, that it concentrated power in the North, that it privileged financiers over farmers, that it would erode states' rights, that it would give a small group of unelected directors influence over the entire nation. Jefferson didn't fear disorder. He feared power, especially when power put on a suit and asked for a ledger. That's Signal 4, power backlash, not a side argument, not a footnote. It's the predictable reaction to building Signal 3. Hamilton and Jefferson turned the cabinet into a philosophical boxing ring. Hamilton wrote a detailed, devastating defense of his plan, a masterclass in economic reasoning. Jefferson wrote an equally passionate rebuttal grounded in constitutional limits and democratic fear. Madison joined Jefferson. Congress split, the cabinet split, the country split. Some saw a national bank as essential for survival. Others saw it as a betrayal of the Revolution. And standing above it all, trying not to imagine the whole republic collapsing under his watch, was George Washington. Washington didn't crave financial experiments. He didn't enjoy political brawls. But he understood something Jefferson didn't. A nation without financial stability is a nation that cannot defend itself. So now the cycle forces a decision. Do you accept the stabilizer and risk concentrating power? Or reject it and risk financial chaos? Washington asked both men to submit their arguments formally. Jefferson's letter focused on the Constitution. Hamilton's letter focused on economic survival and dismantled every point Jefferson made, brick by brick. Hamilton argued that the Constitution gave Congress implied powers. If a bank was necessary to achieve legitimate government goals, then Congress had the authority to create it. Washington read both arguments carefully, and then he sided with Hamilton. In 1791, Washington signed the bill chartering the first Bank of the United States. With one signature, he rewired the country's financial future. The backlash didn't stop the machine. The bank was chartered anyway. Now we find out what it actually does and who it benefits. The first bank wasn't a modern central bank. It didn't control everything. It didn't dominate credit. It wasn't a monetary superweapon. But it gave America what it desperately lacked: stability. The bank issued reliable notes. It accepted deposits. It created a unified payment system. It backed government borrowing. It disciplined reckless state banks. It restored trust in American credit. It made it possible, for the first time, for the United States to function like a real nation, not a loose cluster of post-revolution IOUs. Hamilton built the financial backbone the country needed. But the first bank also created resentment. It strengthened Northeastern finance. It made Southern and Western states feel overshadowed. It deepened the philosophical divide between federal power and states' rights. And it hardened Jefferson's belief that Hamilton was building an elite that would one day swallow the republic whole. The bank worked, but it wasn't universally loved. And Hamilton wasn't universally trusted. And this is the part most people miss. Even when the stabilizer works, it creates political pressure, which means Signal 5 isn't an accident. It's a vote. By the early 1800s, Jefferson's vision, a decentralized, agrarian republic suspicious of banking power, began gaining political traction. Jefferson and Madison built a movement that eventually dominated Congress. And in 1811, when the bank's 20-year charter came up for renewal, everything Hamilton built stood on the edge of a knife. The vote was razor thin, and the bank lost by a single vote. The first bank of the United States died. This is Signal 5, removal and stress test. Not theory anymore. Now we see what was holding the system together. Jefferson's philosophy had finally defeated Hamilton's. But victory has consequences, and America was about to experience them. When the bank closed, the financial system unraveled quickly. State banks flooded the economy with notes. Inflation rose. Credit became unstable again. Each region drifted back into its own monetary world. Foreign lenders hesitated. Domestic confidence fell. People remembered the phrase, "not worth a continental," and wondered if history was repeating. That's the stress test doing its job. When the stabilizer disappears, the system doesn't politely adjust. It wobbles. And then came the War of 1812. A war Hamilton's bank might have helped the country finance. Instead, America struggled. Borrowing costs soared. The treasury strained. The nation stumbled through funding its own defense. Jefferson had won the philosophical battle. But the country paid the price of that victory almost immediately. The collapse of the first bank wasn't the end of the debate. It was the beginning of a new one. Because by 1814, even some of Hamilton's harshest critics had to admit a brutal truth. Without a national stabilizing force, America couldn't function in a crisis. The country had learned, quickly, painfully, what Hamilton had been warning all along. Money without structure becomes chaos. Chaos becomes crisis. And crisis becomes a threat to the nation itself, so the cycle completes. Debt panic, credit repair, institution build, power backlash, removal and stress test. And once a country learns that lesson the hard way, it usually tries to rebuild the stabilizer, just with different rules. The failure of the first bank left a vacuum the country couldn't ignore. And that vacuum created the next chapter in America's money wars, the rise of the Second Bank of the United States. The institution Andrew Jackson would later turn into the centerpiece of the most personal and destructive financial battle in American history. And this cycle isn't uniquely American. After major wars, countries often build a stabilizing institution to repair credit, then fight over who controls it. You can see the same sequence in Britain after the late 17th century wars, when the Bank of England became part of the state's credit machine. Different country, same constraint. That's where we go next. If you had to pick, which risk is more dangerous? Chaos without a stabilizer, or power concentrated inside one? Thanks for watching. I'll see you in the next one.